everybody, welcome back to another episode of Bullish or Bearish. I'm Angela Chu from Success Options Group, and I'm here with my brother Tony for another great episode. And what we're really going to do is we're really going to take another financial topic that you really want to know about and give you kind of both sides of the story and let you actually get an idea of what actually is going on so that you can make a decision that's actually right for you.
Right. And I mean, what we're really trying to get at is like everybody always hears these ideas and like you don't really know what's right for you until you have somebody talk about it or until you learn more about it, right? And barring going to one of our workshops or something, this is our best avenue to get you that information that you need. And so the topic we're going to talk about today is bonds. So I know it's not a sexy thing. It's not a sexy investment. It's bonds, right? And most people, when you hear about it, it's always either stocks or bonds, right? And it's kind of boring, to be frank, right? And people always say, like, if I'm not going to do stocks, I'll do bonds, right? There's different percentages people have done, 60, 40, 70, 30, whatever. Let me just put it plainly and simply. Bonds is guaranteed income. And that's not a bad thing, right? You're setting aside a money, like capital, and you're getting a set amount of money each, like however the coupons are paid out, and then you get your capital back at the end of it. So it's a pretty, like, it's very plain and simple kind of concept.
Okay, so yes, he is talking about what a bond is. But the thing is, what you don't realize is that the return you get on a bond, like when he was just talking about stocks versus bonds, why do more people pick stocks? It's because you get so much more return from stocks than you do on bonds, because the return on bonds generally are pretty low comparatively.
Okay, so that's a good point. Now, here's where, like, if you're in the marketplace right now and you're seeing the stocks, what is happening to your portfolio? So like, this is where people usually, whenever stocks are in turmoil, let's say, or there's volatility, they will retreat to bonds because it's a more stable income. And this isn't even talking about some of the bigger advantage of it. Like, so for example, municipal bonds, right? A state municipal bonds, you don't pay state income taxes on that. You don't pay local taxes. Like, one of my favorites is like water bonds, right? Because it's something where, like, it's a bond, they're going to make water, or they're going to build some kind of facility that does water, and it's municipal bond and it's tax-free. So now you have to add that into the returns that you're also getting from that bond.
Okay, so yes, there are some advantages to taking bonds, but the thing is, you have to realize bonds in general are a long-term investment. Like, you are locked into, like, however much money you put in there, it is locked there. You can't take it out. The liquidity is terrible comparatively to stocks. I mean, once you put the money, if you want the money back or if you need the money back, there's either major penalties if you take it out way too early, and even if you like take it out after like the no penalty, there's the first section is where if you take it out, there's really bad penalties. But even if you take it out later after the penalties are less, you still have penalties unless you wait until complete maturity. So that means your money is stuck there until the bond matures.
I mean, you're talking about some specific bonds. For them, there is a resale market for bonds as well, right? So you're not going to get the full amount, but there is a resale, just like there is some amount of liquidity. It's not like a stock, admittedly, right? Now, the other big thing of why we talk about bonds is it retains its value, right? And as we really talk about stocks and the loss in value, I mean, we've talked about it in prior videos, like the P to E ratios, like stocks, there's a little bit of a balloon effect here, right? And they're a little bit overvalued. And the bonds is how you're going to retain your capital. And then the bigger thing is they're going to keep raising interest rates to fight inflation and that stuff. And that means the bond yields only go up as the interest rates go up, right? So that's why it still could be a very good investment for your portfolio.
Okay, the thing is, you talk about interest rates going up, But the fact is if you buy the bond now, you are locked in at the interest rate that you buy the bond at. If interest rates go up, you are locked in at the price that you bought it at. The price, the interest that you get from the bond does not like increase as the interest rates go up usually. You get what you buy at the time that you buy.
But it retains its value, right? And then you retain your capital, and there are certain like US Treasury bonds, there are inflation adjusted ones as well, right? And I know they're going into a lot of detail on bonds, but there are vehicles, or there are various investment vehicles in this sense that I'm using that can like adjust with the interest rate, right? So then I think that one is like twice a year, it adjusts based off of inflation, right? It's inflation protected.
Okay, now you're saying that, but we've already talked about this in our previous video. None of the adjustments actually match what real inflation is, because what real life inflation is, like no matter all the adjustments the government does, it never actually matches what truly the inflation is. And not to mention, you also mentioned about how like stable and you're sure to get your money back. Maybe for some, but that's not true for all bonds. I mean, there are instances where bond defaults can occur. You know what I mean? Where like if it's not secure enough, it's not safe enough, and the company or whoever you bought the bond from cannot pay back its debt, they can just default, and you can lose all the interest. You can even lose your capital.
Yeah. So I mean, that portfolio or choosing the right investment bonds is important. I mean, a lot of people default to like US Treasury bonds because, well, you're riding on the good faith of the US government. I mean, Angel's smiling to me, but it's depending on how you feel like the security of that bond is. Like I talked about water bonds before. People need water, right? It's going to be hard to default on a bond like that. I think the other thing I want to mention though is like I mentioned the capital, like you're retaining your capital as long as the bond doesn't default, like Anja says, you're retaining your capital. What is the other alternative is stocks. And if the stocks keep plummeting, let's say, now you've lost all of your capital, right? Or you've lost a good major chunk.
So that may be true, but then there's also another risk to having bonds, like to deciding on bonds, because you talked about how, okay, you're locked in and you get that money like consistently, for the next, let's say 5, 10, 20, 30 years. But that's not necessarily true either, because if for some reason, like the interest rates go down, the companies and even the Treasury are allowed to call back the bonds and redeem the bonds, and then yes, you get paid back what your principal and what you've made in interest up to that point. But then now you have capital, and the bonds now are like that you can buy are less, like where you have to immediately decide where you're going to reinvest this money, because if in a sense, if it gets too good, the companies can call it back so that they don't have to continue paying you the better interest rate for a long period of time.
Yeah, it's a good point. But like you said, you get your capital back early, right? And you can reinvest it. And I would just say practically, and we've talked about this in videos, like, do I really think the interest rate is going to go back down anytime soon? That is the question, right?
So, I mean, really what it comes down to is like almost all of our topics, you really have to kind of know, what's right for you and kind of make a decision, because like there are pros and cons to everything. And that's why we give workshops, and that's why we do classes. That's why, we talk about these things on our videos, is because really there's not actually a right answer, because the right answer for one person might not be the right answer for somebody else. So it really depends on each person's individual situation and what they actually want to get out of it.
Yep. So make sure you hit the like, hit the subscribe. Tell us, leave some comments in the chat below if you enjoyed the video. If you wanted to know more, definitely sign up for a workshop if you are piqued or you're interested by this topic and you want to know more. Have a good day.